Hello, folks. Welcome to the end of the year and the sense of things. This is our annual review of what we talked about at the beginning of last year or at the end of last year, our predictions. We will go over our predictions and how close we were or weren't to those predictions and how we feel for the upcoming year. So stay tuned. We'll be right back on in just a second. Hey everybody, welcome to the show. Ron, how you doing, my friend?
Good morning. Winding down another year, and you and I are coming up on 3 years. What are we going to do for our big anniversary?
I don't know. I don't know. Maybe we'll celebrate Festivus together at that point.
Oh, I already got my cartoons ready to go on my phone to send out next week to everybody for Festivus.
Nice.
My
Yes.
favorite is the elf meme with Will Ferrell wishing everybody a happy Festivus. That's my favorite.
Yes. Will be the airing of grievances. Actually, we get to do our airing of grievances today as we look at some of the other doofuses in the industry that did stuff this year.
Absolutely. All right, let's get going here. All right, so I'm not going to read this to everybody, but here's our disclosure. Obviously, these are opinions only for entertainment purposes. I don't know if I've ever seen any analyst ever get it right. The idea, it's like a grenade, you just want to be in the area, something like that, but we had to put the disclosure in. So here we are.
Hand grenades and horseshoes. That's about it. So
100%. So let's review the last couple of years. I'll let you talk about 2024 and then I'll take over 2025 and we'll
yeah.
keep going.
We were totally wrong in 2024. So never expected the market to have as big of a run in 2024 as it did. Interestingly enough, I was pretty bullish going into 2025. And it was interesting to say I came the closest within 20 some odd points right now. Now we still have a week and a half to go of market trading, and anything could happen during that time period. We could end up with my bullish case, we could end up with my bearish case, or Ron's bullish and bearish cases. The way the market's been all over the fence here, but I think it's been an intriguing couple of years in the market. And as we go into looking, if you remember what Ron talked about a few weeks ago of the fact that we typically don't have 4 years in a row of up, it'll be interesting to see how next year performs. But a lot of things are looking good. What's your thoughts, Ron?
Yeah, going back to that one thought, because I'm putting it into my 2026 outlook that
Yeah.
I'm sending out to clients next week. And we've only had 4 years in a row of double digit gains once, or you could look at it twice in the
Mm.
last 75 years. And that was from 95 to 99.
Okay.
That's it. That's
Yep.
it. Yeah, actually, last year, I'm sorry, yeah, 2024, I was bearish along with the
Mm.
majority of the other market strategists, figuring we had better than 50% of a recession, and we didn't get
Yeah.
it. And
Yeah.
this year, my I was really looking good for my bear case in April, and then we got spring coiled to the upside with the delay in tariffs. And look, we both know that there's an air pocket under this market. We just don't know how much. But
Mm.
we'll talk about next year in a minute. But yeah, I think we'll be pretty strong. We may get close to your bullish case by the end of this month. We'll have to see. We had a low CPI number today.
Yeah. Yeah, and it looks like markets like that. Dow's up 1.13% right now, 0.4% on, or the Nasdaq's up 1.13%. So
Yeah.
it's off to the races again. So
And a lot
it's
of people don't
interesting.
realize the last week was a lot of tax harvesting, profit
Yep.
taking, mutual funds and fund managers locking in profits for the year so they
Yep.
can get their quarterly numbers to look good. So what was
Mm.
selling off? All the tech and the
All the
AI.
good stuff.
That's what
Yeah,
was selling off because that's where they had the majority of their profits.
sure.
So, yes, you're going to see money flow in for the Santa Claus rally. Okay.
And mutual funds this year, one of my friends he's a chiropractor calls me and he says, "What the heck happened to my mutual fund?" He goes, like $4,000. I ended up like $4,000 in capital gains. So that tells you how much. I mean, it was like 10% of his portfolio came off in capital gains this year
Wow.
as a result of that, which is just absolutely insane.
Yep. So these were the sectors we were looking at to
Yep.
consider and to avoid. Look, I got 3 for 3. The last one I said was watch consumer discretionary, which was one of your positives.
Yeah.
I just wasn't sure about the consumer this year, but biotech had one hell of a run in the last six
Hmm.
months. I
Yep.
think that's going to continue. We'll talk about that in a little bit. Defense went
Mm.
crazy in the last 6, 7 months.
Yep.
Materials were pretty good too, with all the manufacturing coming back. And on the sectors to avoid, this is my theme going in the next year too, which we'll talk about. Oil, they're going to keep oil prices depressed. And as
Yep.
long as mortgage rates stay high, I don't know why you would go into a lot of the mortgage. I know some of the new home builders are doing well, and the
Mm.
financials actually started to make a comeback in the last couple of months.
Yeah,
You
and
did
then
pretty
and then
good
they
too
got
this year.
smacked at the end, especially like fintech and stuff like that, got smacked right at the end of November. So yeah, I don't think they're out of the clear yet by any means.
I agree. And how about you this year? You did all right.
Yeah, healthcare. I think healthcare and biotech, we both agreed at that time. I really felt tech was going to do well. And it's been just up until a few weeks ago, or about since the beginning of November after the shutdown ended. And we ended up with year end portfolio dressing going on in a lot of these big mutual funds and stuff like that. I wasn't sure on the consumer. I thought with the credit card rates as high as they are and the amount of credit, I just didn't figure consumer discretionary would still have a run. But people keep spending money. I don't know how and why and what that they do it. I also said avoid utilities. They've had actually a pretty dang decent
Yeah, they
year.
did.
So, and then staples, I just felt like that wasn't going to do good, and they have sucked up big time. So I was right on the money with that.
Yeah, Clorox is at I think a 10 or 11-year low.
Yeah,
The chart looks
yeah.
terrible.
Yeah,
If
you
you
look at
got in
any
at
of
the height of
in a lot of
COVID,
these, yeah, a lot of these kind of household name companies have just been absolutely awful over
yeah.
the last year or
And if you
two.
bought in at the height of COVID, you're crying a pool of
Yep,
water right now if
yep.
you were in a lot of these consumer staples.
Now, when you have a growth-based market run, the money's got to go someplace, and unfortunately, it ain't going to go into those guys. So
No,
you at least get paid a little bit of a dividend, but that doesn't offset a 30% drop in the stock, unfortunately.
no. All right, let's poke fun of all the people that are making tens of millions of dollars to not even be in the same zip code, let alone area code. So we'll deal with the ones on the left first. Forget about the 2026 price targets, but let's look and see where some of these super, super smart people were in the beginning. Actually, a year ago now, they were making
Mm,
their predictions. And then, of course, in March, actually in April and May, they were reducing their price targets, and now look where it ended up.
yeah.
So I'll let you take the first poke and then I'll go from there.
I just my favorite is the simple fact we give ranges with our stuff of this is what we think our bullish case is, this is our base, this is our these guys, oh, this is our target, and then they just keep changing it throughout the year. Oppenheimer's my favorite there. It went from 7,100 to 5,950. You were wrong on both sides of the spectrum. Was it Bank of America? Had they just not done anything, Bank of America and BMO, if you just stayed to your guns, you'd actually be right now and you'd be looking pretty dang good. But yeah, even JP Morgan, RBC, all these guys just, oh, okay, we this is where we think it is. Oh no, it was bad in April, and they just changed it and never went back.
Yeah, my favorite part about this is there were a few that did stick to their guns.
Mhm.
HSBC, they stuck to their guns.
Yep.
Deutsche Bank, they stuck to their guns even they were in the high end. My favorite
Mhm.
one was Wells Fargo because they came up with a fakakta odd number and they never changed it. And they stuck by it. We'll say, hey, we'll see where things are. We'll see
It's
how things pan out.
7,007.
Yeah, we'll see how things pan out. I just think look, that's why I do a range. I try
Mm.
and create a field goal post, and
Yep.
maybe the ball will get kicked in between them.
Somewhere in the middle. Yeah.
Yeah, yeah, maybe we'll see, and we'll see where we are in a little bit when we put in our numbers. But let's
Yeah.
look to their 2026 target numbers,
Mm.
and The highest out there is Oppenheimer again at 8,100. I know who
Yeah.
that market strategist is, and
They'll
he
adjust
talks a
that
good
back.
game.
Yeah.
He talks a good game.
He talks a
Um,
good game. That's a hell of a run up, though. 8,100, that's up in the 20% range from where we're at today,
yeah,
which,
yeah. But I look on the right side though. These are some of the lesser
yep.
known names.
Yeah.
Scotia Bank, 63.75.
Yeah.
That's like the bear. And I would
Yeah.
even say Zacks at 68.67 would almost be almost like a bear reading, despite the fact we're
Com
below there right
yeah.
now.
Compared to everybody else. Yeah. I
Everybody's
mean,
looking for anywhere between 12 to 20% upside,
mm,
essentially.
yeah.
Again, going back to history, second year,
Mm,
second year in a presidential term, midterms next year with all the
mm,
uncertainty, and trying to get 4 years in a row of double-digit gains. These are all the headwinds, but you could probably come up with 2 to 3 times the amount of tailwinds with
mm,
taxes and
yeah.
everything else, reshoring and business investment that would help. I think these are pretty interesting. But then
This
again, have you ever?
here's the thing that yeah, here's the thing that scares the crap out of me is when everybody agrees one direction,
Yes,
that scares
that's
the
just
living
about to
crap
say
out of
that.
me. Yeah.
The thing is, have we ever seen, forget about 50%, a third of market strategists say we're going to be lower than where we are
Yeah.
next year than this year?
Yeah. Yeah.
No, they need money coming in. So if you even strike even like an ounce of fear that, hey, we may be lower, people may take
Mm,
their money out.
yeah.
People may not put more money in.
Sure.
So it's a joke.
Yeah, and nobody will pay attention like they'll pay attention now at the beginning of the year with these except here's what our expectations are, but then when we change them during the middle of the year, we're not really going to publicize that a lot because we want to be able to come in and go, "Hey, look how smart we were."
I also think a lot of the reasons why they do a mid-year change, obviously they're everybody's data dependent and they're looking at it. But
Mm,
the other thing is too to get their face on TV. It's
mm,
clickbait for articles. Hey,
yep.
yes, you know what? We're looking for higher. We're looking for lower. Listen to
Mm,
us.
yeah.
It's immensely frustrating. Stick to your guns, people. Maybe
Yeah.
you'll have a little more credibility. We'll see.
Well,
All
like I
right.
said, or do what we do where we give ranges of here's where we think it is, and it probably is going to be somewhere in the middle of those.
Yep. All right. I'll let you take the first stab for this
All
year.
right.
Make your bull and bear case.
All right. So my bull case for the year, I will say right now, I would expect the market to be probably closer to my bull case for the year, and I hope that it is. We're going to have full effect of the tax policies happening this year. Really, the only thing in place that happened with the one big beautiful bill was a lot of the tax incentives for growth and building and stuff like that. Most of the stuff for employees didn't really take place. It won't take place until January. So we're rolling into the beginning of the year with January 2nd. Basically, every time you get a paycheck, you're going to end up getting more money in your paycheck than you were making just a week earlier because the tables were adjusted. Second phase of that is going to be when people start filing their taxes, refunds will probably be a little bit higher because they were withholding more last year. So, a couple of those things, I think, from the consumer standpoint, everybody hopefully is going to feel a little bit more, hey, I've got more money to spend, which they're going to spend it and then say they don't have any money again. I think continued productivity improvement from artificial intelligence is going to continue to do that. And I think there is, and I mean, it's already in place, but massive amounts of spending on construction and infrastructure, info or biotech and health, I think unleashed by the government getting out of the way and letting them get going. If the Republicans, when we get to the election, if the Republicans lose the House but retain the Senate, that kind of neutralizes anything from the Congress, which allows the president to continue to do what he does with executive orders and everything else. Very much similar to Teddy Roosevelt when he was in. Teddy Roosevelt basically had to use he the whole time he was in for 8 years he had a split Congress, and he basically had to just use executive orders to get a lot of things done. And it's very
And
likely that
actually,
would
split
happen.
Congress is almost always bullish for the
It's
market
bullish, yeah,
because
because
nothing gets done.
they don't keep monkeying around and stuff, which is good, or they don't keep creating more problems, which I'm okay with because it forces them to, on the important stuff, it forces them to have to agree on or negotiate at least. So my bullish case is 78-26 for next year. That represents a 15% from whenever Ron and I came up with these numbers earlier in the week. I don't know where it is today. My neutral case is 74-18, up 9%. I think that's probably the likely scenario for next year, quite frankly. I think all those things that I talked about with the bullish case happen, but I just have a feeling that the Mag 7, and this is once again, this is Jeff's opinion only. I think the Mag 7 start to lose a little bit of steam. And the Mag 7 are, depending on which market, the S&P 500 or the NASDAQ, they're almost 40% in some cases of the market.
Yeah, I
So if they lose
think it's higher on the
steam,
NASDAQ.
yeah, and if they lose steam, the market loses steam as a result of that. And I'm not sure that the rest of the on the S&P 500, the rest of the 493 stocks have enough juice to kind of keep the market going at that point and offset that down, that headwind from the Mag 7. What affects the Mag 7? You're already seeing it a little bit right now with the kind of market stumbling over itself for the last month or so, specifically in the Mag 7 area, because there's a lot of concern that these guys are spending a ton of money on updates for AI and all that. And are they going to get the productivity back, the return on investment? Because they're not only putting cash into this, they're financing it with debt and everything else. So that I say could have some issues. Once again, split Congress, I don't think is going to have much of anything. It'll make it harder to get healthcare affordability going, which I think
That's
is
a
the
mess.
biggest problem in this country right now. I think it's the biggest thing affecting people more than anything. My bear case, 61-25, down 10% for the year. That my case there is AI continues to affect white collar jobs, not necessarily blue collar jobs, but white collar jobs. And if people are getting laid off, they're not putting money into their 401ks, which I think has been driving this market because a lot of money goes into 401ks is going into passive investments that just keep pumping a lot of these stocks up. And if we see some major layoffs and we see a slowdown in contributions to 401ks, I could see it easily the market slowing down, dropping, and the other side is Mag 7 profits and everything. And then the final thing on my bear case was if the Democrats win both houses of Congress, then it's going to be 2 years of nonstop investigations and geez, my brain just completely shut off.
Yeah, it'll be bickering
Yeah,
back and forth.
it's just bickering back and forth. Nothing will get done, but then it'll be basically the government will be neutralized at that point and impeachment. That's what I was saying. It'll be a nonstop cases for impeachment like the last 2 years of the Trump presidency. That's my take. What's yours?
All right. So
We're similar on the bullish
yeah,
case.
well,
You're a
I'll
bit
tell you
more.
why I didn't put 8,000 on there because I think
Yeah.
if the market's going to go up, it's going to really go up. Just because in my trading days, there was always something called the law of large numbers. And look right now, we couldn't get to 7,000 this year. We've almost punched the ceiling a couple of
Yep.
times. I
Yep.
think we may have that same issue next year
Mm.
of not, if we really do have a big bull market, we may have a
Yep.
hard time getting through 8,000. So that's why I
Well,
didn't.
you know it. All these years that we've done this, I mean, I remember Dow 10,000, which that's a long dang time ago. But I
Right.
remember my boss coming up to me, and I was working in Dallas at the time. My boss is like, "This is a historic day. We passed 10,000 on the Dow and
Yeah.
all this." And then after it got crushed back down, I came to him and I was like, "Yeah, and
Yeah.
it
But when it got
10,000
back up
again.
to 10,000,
This is
when
a
it got back
historic
up there,
day."
it went right through it.
Yep.
So again, you need to hit the ceiling a few times before you go through it.
Yep.
So my bull case is that the bill that was signed in July just reiterated kind of the tax rates we were in right now is no surprises. Definitely had small and medium sized business incentives to expand their business and reduce taxes. Hopefully, they're not going to pocket it. They'll reinvest it and give it to the employees. We shall. General
Yeah.
business investment. I know our administration loves to talk about the billions or the hundreds of
Mm.
billions that are being. Let's see if that actually happens, right?
Yeah.
There's a difference between an announcement and the actuality, because a lot of
Mm.
what we're seeing right now, they're talking 3, 5, 10 years in advance, but
Yeah.
when they announce it, it does good for their stock today. Let's see what the reality is. Right now, earnings are strong, earnings are
Mm.
good. Productivity. I've always been a big believer in doing more with less, right? So if you let
Mm.
technology do the heavy lifting, we'll see what happens. Now, in conjunction with that, AI spending will continue. And whether or not this was like, and this is the only similarity that I look at the negative with the .com era, was all they wanted to do was just keep spending and build out, and they overspent and they overbuilt, and none of it ever
Mm.
became a reality. We'll have to see where that is with AI spending, but also, are it is next year going to be the first year? They said this year may have been the first year, but will there be a first year or a continuation early on of showing productivity gains using AI? Don't
Mm.
know, right?
Yeah.
I still haven't heard yet how AI is going to how they're going to monetize AI. I still
Yeah.
have not heard of the long term, the medium or the long term vision. They're just saying it'll happen and you got to believe us.
Mm.
That's what they want everybody to do. We'll see.
But I think in the end, it's a lot of it's starting to now go beyond, okay, the really high tech company. You see it with Meta, you see it with some of these other companies where they're really using it for effect. I think the real benefit is going to be sliding out into some of these industrial companies. And I think your case on robotics
Yeah.
there too. I think a lot of the days of the warehouse worker slugging boxes around and stuff like that, Amazon has already shown you,
Oh my. I
you
didn't
know,
realize how
hey,
many robots Amazon was using. I was reading
oh,
an
it's
article the
insane.
other day. They're looking
Yeah,
to double
yeah,
that in the next year
yeah.
or two.
I see it from two aspects. I see it from, hey, this makes sense. And two, also, Jeff Bezos, okay, you guys want to keep trying to unionize? Okay, the robots don't unionize at this
Hey,
point, but
the
you know,
robots will become Terminator. They'll revolt eventually.
yeah, exactly. They'll be throwing boxes around, everything else.
And then, of course, future Fed rate cuts. Now,
Yeah.
I listen, we all want to buy you to finance cheaper, but this
Mm.
could have a very negative effect to inflation, and those embers could spark up into a fire again. And I don't
Mm.
think the average person really understands that, why interest rates go up and down, and that's a different conversation for another
Mm.
time. We've talked about it, but lower rates, by the way, it was talked about again in the address last night, and people just believe it, but it's not true. The Fed does not control the mortgage
Yeah.
rate. They control
Nope.
the short end of the curve. The long end of the curve is basically thrown around by the bond market, who are a bunch of
Mm.
shysters anyway, and it's a 20 and 30-year treasury. It's not the short end of the run, because actually, when they were lowering rates in the last year, the mortgage 30-year fixed went up, it didn't go down.
Mm.
So
Yep.
people don't understand that correlation. That's the bull case. The bear
Mm.
case, I didn't do a base case because I just
Okay.
figure probably the football will be cutting there somewhere in there anyway, right? So the bear case, I look, the tariffs will have an effect. I don't care what people say. They will have an
Mm.
effect. We haven't heard what the Supreme Court is going to say or what they're planning on doing yet, or if the administration is going to defy them. We'll have to see. But there's no doubt in many areas of the market, tariffs will have a negative effect, whether it's inflation, higher cost, whatever, who knows? Or
Mm.
potentially the consumer is slowing down, right?
Mm.
We are seeing unemployment tick up. We are
Yep.
seeing, and I put it in here, auto loan delinquencies have been spiking. Credit card
Mm.
carryover debt, we've been talking about this 2 years, is
Yep.
going up more and more,
Yeah.
breaching 1.3
And
trillion at
even
better than
yeah,
22% interest.
even as long-term rates have come down a bit, the credit card rates are just usury rates at this point, and something has to be done about that.
Yep, yep. And then, of course, war. You got
Yeah.
Russia and Ukraine. I don't care what they're saying. There's no way that Middle East peace is going to hold. I'm sorry.
Mm.
It's just not going to happen. Somebody's going to breach it or going to be provoked. And then, of course,
Mm,
we don't know what the hell's really going on in Venezuela. I don't know if
yeah.
we'll ever know, but we'll see. Oh, there was new news actually last night after I did this. We're
Mm,
going to be supplying Taiwan with a lot of weapons. I
yeah.
think that's interesting. And I think that's more of a ploy for China to come to the table on tariffs more than anything else. I mean, this is a chess game on four different levels. It's just crazy. But
Yes.
I've been saying for 5 years, not if, but when China takes over Taiwan. We don't know when that's going to be, but it will happen. We already talked about the 20 to 30-year treasury yield remaining high, which will keep 30-year mortgage rates elevated, which will go into my thesis shortly, where if we stay above 5.5 or 6% mortgage rates, that's going to hurt the market. That's going to hurt
Mm,
consumers. I truly believe that. And then, of course, the last one, our national debt breached 38 trillion. We went from
mm,
37 to 38 trillion faster than we did in any other trillion range in the past. And I don't hear any adults in Congress talking about how do we
mm.
cut this in half? We're
Yeah.
paying more in the debt than our military budget, meaning what we're paying in just interest payments isn't going to anything benefiting the United States. And I have a
Mm.
feeling at the rate we're running, we could be at over 40 trillion by the end of this year, by end of
It's
next year.
yeah, that's the only place where the law of large numbers isn't working to your advantage. That thing is just it's skyrocketing
No
up. I mean,
politician is going to come out and say,
no.
stop spending. They're not going to get reelected. We're
Yep.
just going to keep printing, which means eventually, probably not when you and I are around, the Chinese yuan will be the
Mm.
reserve currency. It's just
But
going to
I
happen.
think the problem with the Chinese is they're not in much better shape. Their economy's not growing at the clip that it was before, and they're blowing the doors out of massive amounts of debt too. So it's this is a problem all over the world, not just here, but it's a problem all over the world. But if we're going to continue to be the place that people come to, we've got to figure this out and
Yeah.
fast.
Yeah. All right. Let's talk about sectors to consider. You go first, I'll go, and then we'll talk about sectors to avoid.
So my themes for this year really revolve a lot around infrastructure. I just have a belief that with all the stuff coming into place with the one big beautiful bill and everything else, I think industrials, they did extraordinarily well this year. I think they continue to do really well next year. Natural resources, and not necessarily gold and silver, which I think are very much overblown at this point. Silver, I used to trade it when I first moved to Austin. I used to trade silver and it stayed in the $25 range forever. Now it's in the 60s in just a year. And that's not necessarily a good thing because silver is not just a precious metal, it's actually used to make stuff. So that cost doubling in a year. When you think of silver solder and everything else, that's not necessarily a good thing. That import cost is there. But what I'm saying is natural resources, metals, timber, all that kind of stuff. With the building boom that's going to be going on, I think it is a huge opportunity there.
Yeah.
I think, and my themes for this year, industrials and natural resources, clean energy. Ron and I were talking about this, and he was like, energy, what are you talking about? Clean energy. What you have to understand is so many of these, let's say, data centers, if we just look at data centers alone, a lot of these data centers are being built all over the country, and plugging those into the regular electric grid really doesn't work because they can drain the electrical grid. So a lot of these companies are having to not only build a plant, but they're actually building electrical facilities on top of that. And a lot of them are looking at renewable energy, clean energy. So they're throwing in even some small scale nuclear plants. I just watched something this morning on Fox Business where they toured 3 Mile Island and they're firing that up again. It's been closed down since 2019 as a way of generating that. It's Microsoft that is setting up a data center in the area. They're also providing a lot of the AI technology for the new plant or for the reopening of the plant. Last not least, 5G and future connectivity. Think of the big boys here, Google, Meta, Nvidia, but think about Take Two, Roku, Twilio. Those are all companies that are part of this piece. So if you set up a data center, you've got to get that data out of there and into it. So these are the guys that build that piece of it as well. So that's my theme for this year is that overall look at all the bits, pieces, and parts of the industrial side. With my portfolios that I run for clients, I actually set up these three sleeves with about five stocks in each of those that will rotate throughout the year. But those are areas that I'm focusing on as an enhancer to the portfolios for this year.
Gotcha. I'm going to keep mine simple. Healthcare and biotech, I think, are going to continue to run.
Mm.
I think the administration is not only going to let M&A happen, but you're going to see continuing, because it has could happen recently, a lot of the large and mega cap buying up the small and medium cap. It's already
Mm.
happening. Defense and aerospace, we're not going to stop spending on defense. Obviously, with what's going on in Venezuela, we don't really know what's going on yet. And I don't think there's going to be many countries coming to Venezuelans
Yeah,
defense, but we'll see.
besides
But
China,
we're not going to stop spending. And aerospace, Musk, SpaceX is going to go public next year.
which is pretty bad.
I'm really surprised because I know Musk doesn't like answering to anybody,
Yep.
and he doesn't like when people take the other side of
Mm.
his trade, which is essentially the stock.
Mm.
But we'll see. But defense, I think, is always going to continue to run. You buy on the dip forever on defense. That's the theme with that.
Mm.
AI, robotics, and cybersecurity. Even if we have a bear market next year, I'm not saying a recession, but even a bear
Mm.
market, obviously these three areas are going to get hit the hardest. You keep adding to the positions at a discount
Mm.
because this is a long-term play.
Yep.
And if you could buy these at a discount in a pullback or a bear market next year, you're going to do that much better. So if we continue to do this from year to year, you're going to see probably at least defense and aerospace and AI, robotics, and
Mm.
cybersecurity continue to be on my
Be a
list.
permanent, yeah, it's a permanent,
Absolutely.
yeah,
And
fixture.
then, of course, I have it here too, but I also have it on my ones to avoid. But I think real estate is going to be on one side of the seesaw or another, and it's all
Mm.
going to be on 30-year fixed rate. And here's the issue with it for either the ultra positive or the ultra negative. We've essentially been in a bear market with real estate for almost 3.5 years, if you want to look
Yeah.
at it that way. The pent up demand for people to move out of their houses or for people to move into an area or into a house is so high right now. They're licking their chops to try
Mm.
and make this happen. The second part of this is the refi market. If we get the 30-year fixed under 5.5 or even
Mm.
closer to 5%, we're over 6 now, people will be taking money out of their house, right?
Mm.
Doing multiple things, general spending or remodeling their house. So that will create that much more of a consumer boom on the refi market of more money going being injected into the economy of people taking equity out. So
Yeah.
those are my sectors to look at. Talk to me real quick about your sectors to avoid, and then I'll wrap up with mine.
So I think from my perspective, health insurance, it's just going to be a mess this year. Congress is going to try and wade into this. There has to be some major stuff done on this. And the health insurers, I'm sorry, I just can't even invest in them because they have just taken the money from the government and just continue to raise premium after premium to make it to the point where basically health insurance is unaffordable. So
The government should
the
put a cap on the increase each year.
yep,
They won't do it. Too many
yep.
lobbyists.
Yep, absolutely. Utilities, again, this is my second year with that. While I believe that my theme when it comes to the overall with energy and everything else, I think a lot of these utilities are going to have to be making some massive investments in their grids, and that just means less profits going to the shareholder. And yeah, this was somewhat controversial when Ron and I were talking about this. I think AI, I honestly believe that although AI spending will continue, I just have a feeling that a lot of these stocks have a heck of a headwind and have some multiples that are unbelievably high. I just have this nasty feeling that we see a little bit more headwind against them for this year. So that said, I'm going to limit my exposure to them a little bit throughout the year. Could
Gotcha.
be totally wrong. Just saying.
Mine's pretty simple. I got energy and oil again. I agree with your assessment with 50 to 60. I don't think it's really going to stay above 60 or 65 for at
No.
least another year, maybe two. They did
Mm.
talk about, though, if it goes into the 40s, these oil production companies are going to be losing money
Yeah.
because of their cost to get it out of the ground and then refine it. So I still look at energy and oil being depressed. Consumer discretionary 2 years in a row for me. If employment is certainly going up and 30-year mortgage rates are going to be high, I still look at discretionary kind of being depressed. I
Mm.
think it's got another year to bottom out. Maybe 2027 will be a good year. And again, I already gave a little foreshadowing with real estate. If the 30-year fix remains above 5.5, but really above 6 for the majority of the year, mortgage companies, the banks, they're not going to make their vig on all those mortgages.
No.
I think it's going to hurt. It's going to have a trickle effect, right? Not only materials, but labor. It's going to affect financial organizations, banks, so on and so forth. And this is now 3 years in a row. I don't know if we go in a fourth, this could be a huge bear market in this
Mm.
sector going into 2027, especially depending on what happens in the midterms.
Yeah, like I said, and the fact that they're doing nothing to really address the deficit, it just continues to add to the fact that the bond market's, nah, we still don't think it's, we're not pulling it back because we see this thing just keep accelerating. And I think we had a little bit of a chance with Doge, and that just got tamped down by the Washington establishment. And you don't really have those people out there anymore going, hey, we're going to figure out ways to make this, to slow this, at least slow it down. I just think it's going to be a tough sled
Yep.
going
And I and
forward.
I
And
my conspiracy theory is I think the banks and or financial institutions are in the mix to keep the mortgage rates higher. They know they
mm,
can make maybe some money on the downside, but the
yeah,
idea is that they're making some pretty good money on the
yep,
interest alone on the current mortgages. They may try and ride that out for another year
mm,
or two. I don't know. It's a conspiracy theory on my part,
yeah,
but I quite frankly, the 30-year should have been under 5.5, if not
mm,
the end of last year, earlier this year, and it
yep.
hasn't been.
And you're rolling into roughly about 4 year cycle right now of people not really moving. That's why the inventories are where they're at. You're going to get to a point, and I was talking with my realtor friend about this the other day, and he was sharing some of their economists' insight about what they see for the year. And we were talking about that, and we're on that year four cycle. Typically, every 5 years, people move, or a bulk of people move, and we're rolling into that year five going into next year, where it may be some people are just forced that they have to move at
Right.
that point.
The other part of that too is if interest rates on the long end come down precipitously and bring down the
Mm,
30-year fixed, what else are you going to see?
yeah,
House prices
refis
going
out the
up
wazoo. Yep. Yep.
because now there's that much more of a demand. And in
Hmm.
hot areas like us, prices have remained fairly stable and
Yeah.
or have gone up.
Yeah.
I think they've
Ours have
flattened
gone
out
down pretty
recently, but
significantly.
those
Yeah.
interest rates come down, those prices are going to get
Oh, they're
elevated
going to
again.
rock it back up. Yeah.
Absolutely.
That's why we were talking about that just in the watching Zillow, the price of my house from like when it was at its high to where it's at now. It's a pretty wild swing in a period of a couple years to up to the high, which I would have never paid that amount for my house to where it is now. And I'm like, yeah, it really is probably worth a hell of a lot more than they're saying it's worth at
Well,
this
I
point.
will tell you what's not going to change.
Hmm.
Our predictions for next year when we do our mid-year review in 6 months.
Absolutely. Ours will be done. So, folks, we do these for you. I hope you enjoyed it. Bookmark this one and go back to it. Certainly, you can hold our feet to the fire on it. But we will see you guys back here in the new year. This is our last show for the year. Make sure you subscribe because we will be back and on target the first week of, probably second week of January. Because first week
The
of
8th.
January is like right in the middle of January 1st. All right. So we'll see you guys back here after the new year. Have a wonderful time and wonderful holiday season. Enjoy your Hanukkah, Christmas, Festivus, whatever you celebrate.